Hello, my name is True Demon, and I'm the Devil's Stockbroker. Thank you so much for tuning in to watch this video. Before we begin, please understand I'm not a financial advisor, and none of the following content is financial advice. The following content is for educational and entertainment purposes only. Trading stock carries inherent risk, and you should always respect and understand your own personal risks when considering any investment. Please don't take what I say as gospel, and please do not trade based on the information that I receive and share through my content. Thank you so much, and have a hell of a time in the stock market. Hello, everybody. This is True Demon, the Devil Stockbroker, here with a stock market update for the end of the day. I'm going to cover the crowd favorite tickers, AMC, Gamestop, and MULN, and then we'll go into some of the other plays that we're watching as well as some general market news. So, AMC is the first on the list, my personal favorite. At the moment, AMC is still retracing after its long descent on this falling wedge pattern, which it attempted to break out of back in late March of this year. We are now currently at support once again at the $16-15 mark. It's been a pretty boring past couple of weeks in AMC, but I'm expecting volatility to return to it. Since we've been at this flat level of volume for this entire period of time and the short interest has been continuously rising, I'm expecting volatility to start coming back into the stock very soon. I am long on AMC, just full disclosure, for a basket of shares and call options. What I'm expecting for AMC to do here is to repeat some of its previous patterns when it had squeezed back in June of last year, or late May, early June. The signs that I took are this movement here that you can see boxed over on the left-hand side from the 6th of May down to the 25th of May. The pattern is very similar, specifically the OBV pattern. You see this wedge formed on the OBV, and there's also a Fibonacci timeline here that kind of lines up with some of the major events. The retrace that AMC experienced during a high spike of volume, April 27th until the 6th of May, lines up with this period of time back in February all the way until the peak of the selling on the 14th of May this year. And then the retrace, or I'm sorry, the resurgence of volume from May 6th and then peaking on May 13th of the previous year lines up with this move here from March 14th of this year up till March 29th. So these spikes in volume cause the OBV to move in these patterns, showing that volume to the buy side is accumulating and peaked at around 5.25 billion shares on balance, and at a price of about $35 at the high point. This sign has repeated itself twice now. The last time that it happened was in May of last year, right before it squeezed to $73, and the time before that was back in early and mid-January, for the first time when AMC made its first squeeze up to $20. So all of these symptoms, I believe, are signs that AMC is getting ready to make another move again, especially when we combine other factors such as the massive short interest that's been accumulated, as according to Ortex, and the short exempt volume, which we can see accumulating on AMC in the FINRA data. So I'll go ahead and cue that up so that we can see what AMC's short exempts look like. And in the meanwhile, we'll go take a look at Ortex. Ortex, AMC on Ortex shows that the current short interest is 19.23% of the free float. This is not including any kind of naked shorts that would be accounted for, as naked shorts are not recorded. They're taken by an entity such as a broker dealer or a market maker and cannot be recorded, as they are not taken against any borrows and therefore are not loans. So naked shorts are not included in Ortex data. But what we can see is that consistently the short interest has continued to rise throughout a lengthy period ever since about, whoops, sorry, screwed up my chart here. Ever since January of this year when we began, the short interest has steadily climbed, and recently shorts have been getting out of their positions. There's been some additional, since this period of volatility in the stock, shorts have expressed some nervousness. Cost to borrow is still low, but utilization is extremely high, which would indicate that the stock is hard to borrow, but the cost to borrow does not reflect that. So it's hard to say whether or not shorts are actually in a difficult position right now. But the failures to deliver that spiked recently back in March 23rd would indicate that there's that the options volatility and failures to deliver in regards to delivery of options was causing some issues for market makers. If there is going to be a squeeze on AMC, there's no way to know exactly when it will happen, but I'm I'm hoping that it will come within the next 60 days based on this volatility. I've been trying to time it personally, but I'm kind of giving up on the notion that I can predict a squeeze. These are pretty unpredictable things. We'll go ahead and take a look over at GameStop, which kind of held up better. It moved the same. It moved during the same period as AMC, and kind of it made basically the same move, but held up a little bit better, finding its base of support at $135. The It's been a while since I've reset this chart, as you can see. But it is showing consolidation. This is a falling wedge pattern, which tends to be a bullish pattern. If if this pattern were to complete, then what we would see is a bounce off of the bottom here potentially, but it may not necessarily touch this bottom again, and then the price would reach this resistance point and break out, consolidate, and then continue. So that's what we would be looking for with GameStop. If GameStop does complete that pattern, then a breakout of $180, which has consistently been a significant area of resistance for GameStop, is what I would expect to be the sign of a breakout. So 180 meets this resistance somewhere in early June. So it's difficult, like I said, to time these things. Like this is just technical charting. But if there are, if there's one thing that I've learned trading in these stocks is that algorithms tend to like doing things that line up mathematically. So in any case, I'd be looking for GameStop to retest 180 and then break out of this wedge. If it gets rejected here, then I would expect a retrace back to 135. At the moment, it's currently trying to find its bottom. So if it continues to consolidate at this level, I would take that as a bullish sign. We'll go take a look at MULN. Full disclosure, I've resumed my position in MULN. I took a bullish position on MULN today when I saw that we had broken the downtrend. If we go out to the 30-minute chart, there was this after hours breakout, but I'm just going to go ahead and take away the extended trading hours chart just so that I can make this a little bit more clear for everybody. So MULN has been in a downtrend for a while. It broke down below this pennant that it had formed, and it found its support at $1.35, and it seems to be consolidating here, which I feel is a good sign. This is right in the area where volume has been the heaviest in MULN on average. If I were to go ahead and create a volume shelf, whoops, that is not a volume shelf. If I were to go ahead and create a volume shelf, then what you would see is that MULN's volume, its greatest area of support here is all the way down here at $1, which is where it could possibly go to. But if it did return to this level, then I would expect it to bounce immediately off of it. MULN is continuously posting more news on social media recently. The official Twitter handle for MULN actually posted a I would assume a pretty bullish tweet. indicating that they're getting ready for delivery and production of their new electronic vans, the EV vans that they've been developing. So between this break of the downtrend and uh, MULN establishing a clear area of support at a previous high point is all a bullish sign. So I'm expecting a reversal here, in which case we may see a return to this area around $2.50. Now, on to some of our other plays that we're looking at. But before we do that, I'm going to go ahead and take a look here at the market overall. So, if anybody's been watching my videos in the past, I've been paying pretty close attention to the SPY, and I've been looking out for signs of basically a market crash. And I know everybody has been predicting market crashes lately, but before we see a true crash, like a true flash crash, this is not a crash. What you're seeing right now, this is fear, but it's certainly not a crash. If you want to see a crash, look no further than COVID. This is a crash. A single period of volatility where we went from all-time highs at $337 down to a all-time low in a period of a month down to 217. Well, not an all-time low. I should be careful about that. It was a new low that had broken below SPY's previous lows um, in January of or December of 2018 during a market recession. So the thing is that the market has been extremely overbought. We've known this. The Fed's been pumping money into the stock market. They've been increasingly hawkish in their outlook on the market, and they've slowly been, quote, tapering, but it's now they're raising interest rates and bond yields are being affected in a way that is going to indicate that money is going to make its way out of the market. However, there is going to be, I think, a brief period of euphoria again, like it happened before. Um, these events seem to line up with major futures contracts, options expirations, and also major news in market fluctuation. The other factor that I'm paying very close attention to is the housing market, which by now everybody is very aware is extremely overvalued. The median price of homes in the United States is over $500,000, which is just obscene. It's the most overvalued price for homes that it's ever seen. It's never been higher than this. And the last time that we even approached a rate of change like this was back in 2006 when there was an overavailability of financing for homes. Now, because of COVID, we have the opposite problem where lack of availability of homes has exhausted the supply. Massive companies have been purchasing all the homes in mass and causing the price of houses to skyrocket. And at the same time, you have people coming from extremely affluent areas moving into rural areas, coming in, buying houses above asking price, and continuously inflating the market in areas that are well within their price point, but are completely outpacing uh, middle class. And add to that the fact that we now have a brewing rent crisis with people basically at risk of losing their apartments because landlords have lost too much money during the COVID crash and cannot continue doing business. So all of this is brewing into a situation where the middle class is so separate from the upper class that the middle class will be priced out of homes. Interest rates on mortgages are about to go so high that nobody will be able to qualify, even with a 20% down payment, which by now, with a median price of $500,000, is going to end up at a median of $100,000 for a 20% down payment on a house. So there's no way that your average middle class is going to be able to put down $100,000 down payment on any home anywhere. It's just not feasible. So, long and short of it is I'm looking for the SPY to make a bounce in the short term, but long term, I'm expecting the market to correct massively. And I'm kind of looking for it could be as bad as a doomsday scenario as far as I can tell. Because one thing that I've learned is that when 80% of your population is not able to house itself, the last time that that happened was in the 1920s during the Great Depression, and the market lost 90% of its value. So, on that cheery news, we're going to look for some other opportunities that Hell's Trading Floor is paying attention to see where we can find some value and get off a few bullish trades in order to prepare for such an event. A couple of things that I've been looking at is ALZN. This is Alzamed Neuro Inc. This is one of the plays that I had gotten into early on, back when it was trading at around $1, and it had experienced this retrace, bounced off of 90 cents, and then surged all the way up to $1.50. We caught that ride and then slid back down, and we've retested that support at 90 cents, and now we're starting to see volume coming into the stock throughout today and after hours. The MACD crossed the day previous, and now we're starting to see a resurgence of volume coming back into the stock. Additionally, the chart pattern formed a falling wedge, which is actually quite a bullish pattern. So there's several signs pointing to a reversal coming into this stock. And I mean, at 90 cents, you really can't complain about the price. If you're looking for fundamentals about the company, the long and short of it is that they're creating novel treatments to treat and test for Alzheimer's and early onset dementia, and trying to help people with treatment plans and eventually work towards a cure. ALZN is it had retraced back to its support of 90 cents, and I ended up buying a little bit more during this dip, and it looks as though it's getting ready to break back out right away. The clear breakout point would be $1. If it can break out above $1, then it's pretty much got up till $1.50 again before it runs into any resistance. The thing that I am waiting for is some bullish news on their new treatment plan products, and basically just for a potential acquisition. There's been some rumblings about that. If ALZN were to be acquired and or absorbed into a larger firm, they don't have a very big float. They're actually pretty cheap and easily acquired at this current price. And for that matter, ALZN is actually one of those stocks that would be quite easily squeezed. There's not much short interest, about 2% of the stock, to the tune of 1 million shares. But it's worth mentioning that shorts got in at a very early price point, or a very low price point. They actually got hurt in this area. They covered a little bit and then re-entered their positions. So they may have caught some profit on the way back down, but overall, I would say that shorts have been losing on this stock as the price has not been able to break down below 90 cents. Part of what I suspect, based off of the high spikes in short exempt volume on ALZN that keep consistently happening as it reaches these price points, is that a market maker is trying to help facilitate driving the stock below $1 in order to put it in the cellar for, quote, seller boxing. This is a situation where a stock below the NASDAQ listing requirements can be put at risk of delisting, and the market maker is able to trade. It's able to trade the stock algorithmically using just pure short exempts and profit on the trades in both directions at extremely high volume, while simultaneously profiting on the spread. And eventually, it just causes the stock to trickle down, 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 and sink further away from $1 to the point where it gets delisted, and or the company is forced to make a large reverse split and consolidate its stock. If this can be avoided, however, ALZN has an extremely high amount of options interest for May 20th, and in addition to that, with it being such a small float, the stock can actually easily be pushed, and it's got the interest of several pump and dumpers in the past. So I actually would expect that if a move can happen in ALZN, it may actually happen sooner rather than later while it's in these low prices. Um, CYN is another one that I'm just kind of looking at the moment. It's setting up similarly to BRQS. Um, it spiked up very suddenly and then consolidated and is continuously testing new highs at $3, but it's establishing higher lows, which is actually a very bullish sign. So CYN is another one that retail has been targeting for a short squeeze, or so I think. Um, I haven't been convinced just yet, but I am going to be paying attention to this one. ATER is actually a new favorite of mine. I had purchased some calls during the first run, um, or rather as it was coming back down. So I was a little bit early on this trade. I was expecting it to bounce at this area of support, and it broke through $5 instead. But I purchased some more down here at $4, and now we're currently suddenly ripping up in after hours. So ATER is looking very strong. And I want to spend a little bit of time discussing this one in particular for that exact reason, because ATER is showing some supreme strength right now. If you look at ATER on its 15-minute delayed, this is our Scourge bot, which has access to 15-minute delayed options history, and we have a few heat maps and tables to point out where most of the options premium is at. Now, last Friday, ATER had approximately 60% of its float uh, expiring on the options chain. About 20% of it expired in the money below $4. There was a huge amount of deep in the money call options that expired and were exercised, we presume. Now we have these ones set up for this week. A lot of calls expired out of the money last week, but enough of them expired in the money that it forced market makers to hedge those positions. Now, what we're seeing in the current trading session, I suspect, is that ATER is actually being bought up now in preparation for share settlement and delivery, which needs to happen by Tuesday at the opening bell for any shares that were exercised, or calls, I should say, that were exercised on Monday. Now, does this mean that ATER will continue? It could, but there's a few things that need to happen. Now, ATER is a lot of those calls that are still in the money right now, getting ready to expire. These are going to be extremely important. If you're not familiar with the concept of delta hedging, let me first explain that, and then we'll go into the reasoning why these in the money call options for ATER this week are so extremely important. So, delta hedging is a situation where a market maker is automatically moving in and out of positions on a regular basis for call options. Most of the time, market makers are making money by selling calls and puts and facilitating trades by making more money on the spread. If a stock begins to move against the market maker's position in either direction, then they must delta hedge. In the case of calls, if the market maker sold calls, then in order to delta hedge, when the price is rising, the market maker must purchase shares with the expectation that those calls may be exercised. Now, this has an effect of the market maker purchasing stock or borrowing stock in preparation for delivery, and then they will be forced to deliver them if those calls are exercised or expire in the money. In that situation, the market maker delivers the shares and all is right with the world. The market maker takes a loss on the position, on the net books, but usually they facilitate enough trading to make a profit anyway. Now, if the price is getting close to expiration and it's just close enough, what the market maker may do is de-hedge the position, or they may leverage a large borrow and then short the stock significantly and cause the price to decline rapidly, which causes a bunch more call options to go out of the money, which then the market maker is free to de-hedge, and they unroll the position which they delta hedged for. So they sell the stock, which causes it to go down further. So all those situations work against retail in a way that if you are waiting until Friday to exercise your calls, you are actually hurting yourself. And here I will explain why. If you are holding calls until expiration, you should be planning to exercise them. Now, this isn't financial advice, but what I'm saying is that when you buy a call option, you are buying the right to purchase a stock at a given strike price, and you pay that premium for that right. That's what the premium is for. You are purchasing the right to exercise that and get those shares at the preferred price. If your calls are in the money and they are nearing expiration and you are going to exercise them anyway, then you should exercise them early. If you are not planning to exercise your calls, then you should sell them and let them go into the hands of somebody who does. Otherwise, you are likely working against yourself. Here I will explain a scenario in which retail is actually able to leverage call options properly in order to essentially fulfill its own prophecy. ATER is currently trading at $5.24 at the current market price. Now, market makers are probably going to hedge for any positions, for any calls that are in the money. They probably have already done so. If we look at this heat map, we see that this week we have a whole bunch of call options at the $5 strike price and below, which are in the money. Now, if you wait until Friday to see if they're going to expire in the money, then okay, yeah, you might be able to negotiate that. You might be able to exercise that and get those shares, or you might be able to squeeze a few cents. But right now, in the final week of trading before expiration, theta is eating away at the value of the premium for these options. Eventually, the theta will eat away at all of the premium value to the point where all you are left with is delta. And delta is the intrinsic value of the option based on the difference between the strike price and the current trading market price. Once you get to that point where delta is all that is left, then the option basically has no premium value and you're not going to be able to trade it and you won't be able to get out of it. This is where market makers pin the price and they really hurt you. They will pin the price at exactly the strike that will result in premium being almost zero and delta being perfectly 1. This results in the call that the market maker sold at that strike price. They profit off of it because they were able to purchase the shares anyway, and they're able to deliver those shares at a better price, but you paid them premium to get that already. Now, what happens if the price is somewhere up at $5.40? The market maker has probably hedged for it, but if the price starts to decline, then the market maker may de-hedge the position as it approaches out of the money, and they can slam the price and force it below the strike. In another scenario, imagine that retail, instead of waiting until Friday for that de-hedging to occur, if retail exercises early ahead of 2-day settlement, because it does take 2 days for these shares to settle, then it forces the market maker to buy and deliver those shares within 2 trading days. They are those shares are then taken out of their hands and they are no longer afforded the opportunity to de-hedge. So imagine a scenario if you are waiting until Friday anyway. If your call is in the money anyway, then and you do not want to sell that call, if you want to exercise it, then why are you waiting to exercise it? There's no point. If it's already in the money, if you want those shares anyway, then do not let the value slip away. And in addition, by doing so, you are actually helping yourself and other traders who are taking a bullish position on the stock. Here's why. Currently, the stock is trading at a little over $5.50. So right now, $5 and below is in the money, $5.50 is out of the money. If, say, all of the traders who had these call options at, we'll just say from $2.50 and up, exercise their calls and purchase those shares at the strike price, then all of these shares would need to be hedged for by the market maker, purchased and delivered to the trader who purchased and exercised the calls. Doing so forces the market maker to then give up those shares and take their own and take the equity out of their account and deliver it directly to you. That period of 2-day settlement will then take effect, and then the purchasing of those shares will force the price to go up. If that happens enough, and if enough retailers were to exercise those shares early, as in Monday, Tuesday, or Wednesday, then all of the hedging that is done by the market maker must be done before Friday's expiration. Friday expiration is what the market maker counts on, and this is why you almost always see price declines rapidly on Friday right before close. And then the price just magically gets pinned right at the strike price, such to cause the most number of options to expire. By waiting until Friday, retail often shoots itself in the foot with the expectation that, oh, if I hold it, then maybe I won't waste my money exercising. But if you wait, then by not exercising, you are giving the market maker free rein to take both your premium and sell those shares into the market to use that selling pressure against you. It actually is detrimental. So this is the reason why I talk so much about exercising call options and emphasizing early exercising the week of or the week before your calls expire. So it's something to think about, because if it were to happen en masse, this is what can happen. Say you get all of these people who are like, these are the easy exercises. It's like, okay, $3.50, my calls are at a delta of 1, and I have almost no theta. I want the shares, I'm going to exercise. So everybody in this area, they all exercise. That's 585, 513, a little bit over 1,300 call options. Multiply that by 100, you get 100,000. 130,000 shares. So 130,000 shares of buying pressure. That gets added and the price gets pushed up just a little bit more. Then suddenly the $4 in the money calls are like, oh, well, it's $1 above me now. I'll just go ahead and exercise too, because my delta has risen up to 1. Exercise those shares or exercise those calls, you get another 2,364 calls, or 23,600. Oh God, I'm sorry, my head math is all wrong. But this number of shares, this number of calls multiplied by 100 is the shares that get purchased and delivered to those who had the calls. And as you go further and further up, if this continues to happen, then you see there's a rise in the OI of the calls. If the $4, $4.50, and the $5 all exercised as well, then it's a very strong likelihood that the market maker has not hedged for these calls. And if those shares are taken out of their inventory and they must deliver those shares, then they can't play with them. They can't negotiate with them, and they cannot use them against you. By waiting for Friday, you're anticipating, you're basically just waiting for the market maker to take a shit on you. If you exercise early, then you're forcing the market maker to take those shares that they hedged for and allocate them to be delivered, and they take them out of their books to be used for trading back and forth and for de-hedging. And the more of retail that exercise the calls and do not give the market maker the chance to pin the price, they can actually cause gamma squeezes this way. Because what happens is the in the money options are exercised, the market maker purchases the shares, delivers them, and then it causes the price to rise, which then allows the next strike to be exercised, which causes the market maker to have to purchase more shares to hedge for the next strike, and so on and so on and so on. And with a hedge, with a wall like this, you get a ridiculous rise in price. And this is the wall that you're looking at. This is the kind of gamma ramp that can actually take the price completely out of control. This is the gamma squeeze chart that our ScourgeBot has created for ATER, which shows that currently at a market price of $5.11 or just above $5 strike price, 18% of the float is in the money. At the next strike price of $7, at several strike prices higher, at $7, more than 26% of the float is in the money. If you take this all the way up to $10, 68%. I'm sorry, a 68% rise in ATER would cause 44% of the float to expire in the money. This is a massive gamma ramp. Anytime you see more than 20% of a float in the money at a very near interval of strikes, that is an opportunity for a gamma squeeze. ATER is one of those situations where a low float stock with a very unusual amount of open interest on its call chain can cause a run unlike any other. This is the exact same thing that happened to SPRT when SPRT had more than 110% of its total float on the options chain in the money when it expired. I believe it was August 27th of 2021. And as the price rose higher and higher and higher, it eventually caused that 110% of its total shares to go in the money on the call chain, and it squeezed all the way to, I believe it was $56, but I'd have to double check the chart on that one. Now that was a true gamma squeeze. SPRT was a true gamma squeeze because the supply crisis combined with euphoric buying of call options and continuous purchasing of shares caused the price to rise so far out of reach of market makers, and retail were exercising their calls in droves to the point where the market maker had no opportunity to de-hedge the positions. It absolutely slaughtered market makers and bears on the SPRT play. And the same thing can happen on ATER. ATER actually has more shares in its inventory than SPRT did, and SPRT was trading at $10. ATER has a much bigger ramp because it's trading at half the price with 4 times the size of the float that SPRT had. So consider that math, that even though it's a smaller percentage of what SPRT was at 44% or 55% if you count all the way up to $13, but this is entirely within the realm of possibility. But several things need to happen. One, the purchasing of calls needs to continue up until like May 20th or so, and there needs to be continuous exercising of in the money calls ahead of schedule before market makers can predict the need to hedge for those calls. And thirdly, shorts need to keep losing. Right now, shorts are actually getting hammered pretty badly on ATER. Nope. Okay, I did get the right one. So here's our text on ATER, where you can see that 42% of the total free float is currently sold short on ATER, with a massive spike while the price was still down at $2.59 on the day that it opened. ATER is now trading at almost a 100% loss for those shorts. It is trading significantly higher, and the shorting has continued to escalate. Shorts are still adding to their positions. If ATER can outpace the short's ability to short the stock, with this cost to borrow rapidly ascending and the utilization completely maxed out, and the stock being on the threshold list for the last 12 days, this is significant. And you add to that the fact that 40% of the 40% of the stock is about to 40% of the stock would be in the money on the float at a strike price of about, I'm not sure if this is $7 or $8, but we'll go ahead and pull this up. Looks like 7.5. So 7.5 strike is a big one, particularly for May 20th. So this is what we are trying to put in the money. If you want to see ATER squeeze, it has to get above $7.50. But in order for that to happen, all of these calls down here below $5 need to be exercised as early as possible in order to take those shares out of the hands of market makers and make sure that they cannot unhedge their positions. Those are the factors that would need to take place. And then you can see a rapid ascension in the price. So right now, all of the factors are in play. ATER is absolutely on point for a gamma squeeze. It can happen. A combined short and gamma squeeze is definitely possible on ATER. The short interest is there. The shorts are losing. Cost to borrow is extremely high. Utilization is totally maxed out, and there's a massive amount of calls on the chain, and ATER is actively combating shorts and trying to help its retail investors. This is something that very few companies are actually doing. BRQS, the stock is actually doing extremely well. This is a penny stock play for those who aren't aware of it. They currently have a float of 126 million shares or so, which is it's a little less. I think they have 160 million outstanding shares currently. We called this play back at around, I believe we called this on the 19th of April and took a position right around 21 cents. And it made a huge move literally minutes after we called it. And it's been ripping ever since. Now it entered into this consolidation zone. So this consolidation is getting ready to come to an end here. If the stock breaks out of this pennant early, then I'm expecting it to make a run for up to 50 cents is approximately where I expect it to run to. There's an algorithm playing with this one. A lot of these movements, if you notice, they kind of mirror each other. So I'm trying to call out some of the repeating patterns. And this is one of those ones that I actually do want to pay close attention to what's happening after hours. It's not often I do this, but these patterns are playing out in after hours as well. Note the similarity between these patterns. We had a high and a low and then an immediate cup, a high, low, and a cup, and then a long consolidation to the downside. and then it hits a very significant low in pre-market before it continues, and then it establishes another high over the course of the next several days. So this pattern just repeated. So what I'm expecting is for this continuation up to the next area of resistance, which I'm estimating is at 50 cents. So that's my reasoning for choosing that price point. I may be wrong. It may go further. It may not reach it, but that's just what I'm playing it to. And I am day trading this one. This is one of those stocks where I've noticed repeating patterns and I feel comfortable day trading it. But I also think that this could be a squeeze candidate since retail has building interest in this stock and it has continuously beat expectations. The one thing that I would be careful of is that there's always the possibility of dilution. Although I don't think that this company will dive in headfirst into dilution right now because they're currently trying to get into compliance with NASDAQ. And in order to do that, they need to get their price above $1 before the 20th, or I'm sorry, the 15th of August. And it needs to stay there for 10 consecutive trading days in order for them to be compliant with NASDAQ listing requirements. So if all of those factors are met, then this company will be out of the woods and they'll be able to stay on the NASDAQ until such a time where they no longer meet listing requirements or until their price goes far beyond and it's not a concern anymore. In the short term, I'm looking for BRQS to continue to consolidate, and I'll be looking for it to break out of this wedge in the next few days. Another squeeze play, two squeeze plays actually that I am looking at is CRXT and Rdbx. So Redbox Entertainment, this is actually a call out from Cadude, who let us know at Hell's Trading Floor that this was a trade that he was staring at. And after this run up and retrace to I think it was like almost $4. Yeah, it was like $3.93. It retraced, so I took a position when it touched this low again and made its bounce. So I entered into a position here, and now we're sailing again past $4. So this one is actually looking really, really good. The reason for this call out was the extremely high short interest on it. So short interest on Rdbx was over 40% of the free float, which is insane. I believe it is on the threshold list. It has been on the threshold list in the past, but it is not currently. Shorts have been adding to their position for a long time. So the first real spikes occurred back when the stock was trading at around $10. They added even more when it was trading around $6, and then they really added to it when it was trading below $2.25, and they've just been adding and adding and adding and adding ever since. I think they flew a little bit too close to the sun, and Cadude's thesis agrees with me. He's actually got some DD on Reddit, which I will link in the video description. And I really do like the thesis for this one. The thing that I'm noticing is that short exempts were spiking significantly. This is just security lending volume. This includes but does not specify the short exempts. So if you want to look at that, you'd have to jump into Hell's Trading Floor and check out our ScourgeBot tool. Or you can check out the FINRA short interest online at finra.org. But in any case, the security lending volume in this one has been continuously spiking, and short exempts have been getting a little bit more and more and more ridiculous. So because of that, Rdbx is one that I am looking for a short squeeze as market makers continuously lose control. Okay. So looking at the short exempt data for Rdbx, we see that on the 21st, we had a massive spike in regular and short volume to the tune of 19.7 million shares short volume, and 202,000 of that was short exempt, making it a short exempt ratio of 1.0. If we compare that to Redbox's float, though, that is almost the entire float. Almost the entire float was traded on this stock in just short volume on that day. So here is what it looks like on a graph if you were to compare them on a scaled chart. The shorts total volume and ratios are down here in the lower hand chart. So if you want to, you can pause the video and take a look at these for an extended length of time, analyze it, make sense of it. Redbox is a similar one to BRQS, which it does not have options, hence why I feel like this is a strong candidate for a squeeze. This one actually has some serious potential to move in favor of retail, and I am absolutely buying. So I've gone and accumulated a modest, not a significant, but a modest position just with what I was able to spare, and I'm currently already up 50% on my position. Very happy with that. And I'm going to continue to hold this one because I think that Redbox, I have very nostalgic feelings about Redbox. I grew up when I grew up as Blockbuster was going out of business, and Redbox was starting to show up in my teenhood, and I was pretty excited when I could just walk up to a Walmart and go pick out a video from a vending machine. I thought that was pretty cool, and I really enjoyed being able to rent videos and games from the nearest vending machine. And you know what? With the way that things have gone with Netflix and its decision to include advertising in its business model is just, it sounds like such stupid sabotage that I feel like a whole bunch of people are going to be canceling their subscriptions any day now. I think that covers everything here on all of these tickers for the day. Thank you guys so much for stopping by, and we will see you in the next video. Have a hell of a time in the markets.